Okay, now that you know your accounting equation, we're going to use the expanded accounting equation to do transaction analysis. Transaction analysis is where you're going to take each transaction for a company and see how that transaction affects the accounting equation. First, let's define a transaction. A transaction is defined as an event that has a measurable financial impact on the business. So for it to be a transaction, the event has to have a measurable financial impact on the business. I'm going to show you how to do this on a spreadsheet, and you will see as each transaction progresses, the accounting equation will always remain in balance. Let's start off by reading the question. It says, after several months of planning, Jasmine Worthy started a haircutting business called Expressions. The following events occurred during its first month of business. Then they've listed all the events. Now there are 11 events, and what I'm going to do is I'm going to take them one by one and show you how the accounting equation changes. So this is the way that I have set up this table. I will put the transaction that we're going to go through on top here. Then I have three areas. So assets will be here in this section, liabilities will be in this section, and equity will be in this section right here. So let's get started. It says on August 1st, Worthy invested $3,000 cash and $15,000 of equipment in Expression in exchange for its common stock. So what happened with this transaction? First of all, is it a transaction? For it to be a transaction, it's an event. Yes, it is. It has to have measurable impact on the business. Can we measure it? Yes, because it can be measured in terms of money. 3,000 and 15,000 is how much Worthy invested in this business. So let's go and see how we're going to record that, or how the accounting equation is going to be affected by that. So first, when you're doing accounting transactions, we're going to put down, we'll just put down transaction 1. That way we can keep track of it, the first transaction. So what the first question we're going to ask is, what are the accounts affected by this transaction? What are the accounts affected by these transactions? So we have cash. So the cash account is going to be affected by these transactions. And we have equipment, $15,000 of equipment. Both are going to be affected by this transaction. But don't forget, there's common stock. That too is going to be affected by this transaction. So there are three accounts that are going to be affected by this transaction. What are they? Cash, because we have $3,000 cash. Equipment, because we have $15,000 worth of equipment. And in exchange, we gave the owner common stock. So common stock is also going to be affected. I'm going to remove the one from here and move it one level down so I have time, or I have space to put the column headers. Now we're going to put column headings. First of all, we have to know what type are all these accounts. So we said cash, equipment, and common stock. What type of account is cash? We know that cash is an asset, so I'm going to put cash right here. Then what about equipment? We know equipment's also an asset, so I'm going to put equipment right here. And then what about common stock? What type of item is common stock? We know that common stock is equity, so I'm going to go ahead and put a column for equity right here. Now let's take the cash account. What happened to the cash? Did that cash account increase or decrease? And by how much? Well, for us to figure out whether it increased or decreased, first we have to know what was in that account. That helps to figure out whether it increased or decreased. Well, this is a brand new business, so if you look, there are no balances on any of those. So we had 0 with everything. Since we had 0 and we received 3,000 cash, we're going to show that 3,000 as an increase in cash. So we're going to put it as a positive number. Now this shows that our cash increased by 3,000. Remember, our accounting equation is not in balance because we have not entered the rest of the event or the transaction. Along with that 3,000 cash, we received $15,000 of equipment. We had no equipment. Now we have 15,000, so our equipment also increased by 15,000. Is that it? No, don't forget, in exchange, we have common stock. We issued common stock to our owners, which is equity. So instead of equity, I'm going to change this to common stock. And common stock is how much common stock did we give? For our accounting equation to be in balance, we would have given 18,000 common stock. Now the question is, why did I put that as a positive number? Well, think about it. How much common stock did we have before? Zero. This is a brand new business. We had not issued any common stock before. So issuing this common stock increased our common stock account to 18,000. Also, another way of looking at it, the accounting equation always holds true. So if we have an increase of 18,000 in assets, we should have an increase in 18,000 of liabilities and equity. Let's look at the second transaction. Second transaction says on August 2nd, Expressions paid $600 cash for furniture for the shop. So now let's take a look and see what are the accounts affected by this transaction. So what happened? We paid $600 cash and bought furniture. So what accounts are affected? Cash and furniture. Cash is an asset. How about furniture? Is that something the business owns? Yes, it is. Therefore, it is also an asset. So we're going to put furniture right here. Now let's take a look at how this accounting equation changed. Did our cash go up or go down? We paid $600 cash, so our cash went down. So we're going to reduce cash and say this transaction reduced cash by $600. Now what about furniture? Did furniture increase or decrease? We had no furniture, but now we have furniture for $600. So I'm going to put that. Now, did the accounting equation stay in balance after we are done with this transaction analysis? Yes, it did. We had total assets of 18,000, total liabilities of 18,000. Take a look at this transaction. This transaction occurred on the same side of the accounting equation. Therefore, one of the accounts reduced, the other one increased, keeping the accounting equation in balance. Okay. On August 3rd, Expressions paid $500 cash for rent space in a strip mall for August. Okay, let's take a look at what are the accounts affected by this transaction. Cash, which you know is an asset, and rent. Well, what type of item is rent? Earlier we said that rent is an expense, so it's a cost of doing business, and expenses are a subcategory of retained earnings. So what type of account is retained earnings? It is a equity account. So we're going to move to this side and we're going to put expenses under the equity section. Remember, expenses decrease retained earnings, so we're going to put negative, actually we're going to put a negative expenses so that you keep in mind that expenses decrease retained earnings. Now let's take a look at it. What happened here? 500 cash. Did cash increase or decrease? Cash decreased by 500, so we're going to reduce cash by 500 here. What about expenses? Did expenses increase or decrease? Now, how much did we have for expenses here? We didn't have any. We had zero, but our expenses increased by 500. So I'm going to put 500 as a positive number here, but keep in mind we're already accounting for expenses reducing retained earning by taking it out here. So that's why your accounting equation remains in balance. So expenses increased, but expenses decreased retained earnings, and as a result, both sides of the accounting equation decreased. Okay, let's take a look at transaction 4. On August 4th, it purchased $1,200 of equipment on credit for the shop using a long-term notes payable. So again, what happened here? We bought $1,200 of equipment. Did we pay cash? No, we bought it on credit. How did we pay it? Was it on account? No, we signed an IOU or a note for it. So we are using a long-term note payable. The two accounts affected are equipment. Did equipment increase or decrease? You know that equipment increased by $1,200. So we're going to put the $1,200 there. What type of account is long-term note payable? Payable is a debt. We just entered into debt, so it's a liability, and we're going to pay, say, long-term note payable. Now, did our long-term notes payable increase or decrease? We didn't have any debt. Now we just went into debt, so our long-term liabilities also increased. And the accounting equation is still in balance. Transaction 5. It says on August 5th, expressions opened for business. Cash received from haircutting services in the first week and a half of business ended August 15th was $825. This is a transaction. Yes, it is. This represents how much cash we received from cutting hair. Now, we know what are the accounts affected by this transaction. We know cash. And what do we call when we sell products or sell services? When we earn what we earn when we sell products or services is called revenue. What type of account is revenue? You know that revenue is equity account. It's a subsection again of retained earnings. So we're going to put revenues right here. We're going to put it as a positive number, as a positive item rather, because revenues increase retained earnings. Now that we know the two types, we can go ahead and analyze this transaction. So what are the accounts? Cash and revenue. Did cash increase or decrease? We received cash for cutting hair, so we're going to put 825 as a positive number right here. What about revenue? Did our revenues increase or decrease? We had nothing. Now we have $825 revenue, so our revenues increased by 825. Finally, is the accounting equation still in balance? Yes, it is. So as you notice, for each transaction, the numbers of the accounting equation change, but the accounting equation always holds true. Transaction 6. On August 15th, it provided $100 of haircutting services on account. Now, what happened? We provided service. What do we call that? We call that revenue. So revenue is one of the accounts. And then did we receive cash for it? No, we provided it on account. So what do we call when we are waiting to receive money from clients? When we are waiting to receive money from clients, we call that account accounts receivable. So accounts receivable and revenue are the two accounts affected by this transaction. So let's go ahead and put that down. So this would be AR. I'm going to abbreviate it as AR for accounts receivable. So transaction 6 says our accounts receivable, did it increase or decrease? We had nothing. Now we have $100 waiting to be received, so it increased by 100. What about revenue? We had 825. We just earned another 100, so our revenue also increased by 100, keeping the accounting equation in balance. Transaction 7. On August 17th, it received a $100 check for services previously rendered on account. So what's happening here? We received a $100 check for what? We received a $100 check for services previously rendered. Well, did we provide services previously? Sure we did. We had $100 that we were waiting to receive from customers. Well, guess what? That customer just paid us $100. So what happened? What are the two accounts affected? Accounts receivable and cash. So we're going to increase cash by 100 because we just received a check. What happened to our accounts receivable? When that customer sends that $100, they don't owe it to us anymore. So our accounts receivable went down by 100. A lot of students mistake this transaction for additional revenue earned. We did not earn any revenue at this point. Remember, revenue is earned when services are provided. The services were provided a while back. Now the customer here is just paying what they owe us. Okay, now transaction 8. It says on August 17th, it paid $125 cash to an assistant for hours worked during the grand opening. So what happened? You know that cash is an account that's affected by this transaction, but what else? We paid somebody. We paid an assistant. That sounds like a salary or wages. What type of account is salary or wages? Those are expenses. Those are costs of doing business. So the two accounts affected are cash and expenses. Let's first look at cash. What happened to cash? Did cash increase or decrease? Well, we paid 125, so our cash decreased by $125. Did our expenses increase or decrease? We had $500 worth of expenses earlier. Well, now we have another $125 more in expenses, so we're going to increase our expenses by 125. The total of 625 will get reduced from retained earnings in calculating your accounting equation, but expenses increase, so I'm going to put that as a positive number here. And your homework questions will probably do the same. Transaction 9. Cash received from services provided during the second half of August was 930. So we know that cash is affected because we received $930 of cash. For what? For services provided during the second half of August. When we provide services, we call it revenues. So revenues and cash is what's going to be affected. What happened to cash? Cash increased by $930. And then what happened to revenues? Revenues also increased by $930. We had some already, and it increased by another $930. Transaction 10. On August 31st, it paid a $400 installment towards the principal on the note payable entered on August 4th. So what's happening here? We're paying off $400 to a loan. Did we have a loan? Did we have a note payable? Sure we did. We had a long-term note payable of $1,200. What are we doing? We are paying back $400 towards principal, which means we are reducing that note balance. So now let's take a look at the accounts affected, note payable, and how do you pay off a note? By using cash. So cash and long-term notes payable are the two accounts affected by this transaction. What happened to cash? We have to pay cash to reduce the note, so cash is going to go down by $400, reduced by $400. What about the long-term note payable? We have $1,200 that we owe. When we pay $400, it's going to decrease by $400. Therefore, now we only owe $800 on that loan. Transaction 11. On August 31st, it paid $900 cash in dividends to Worthy, who is the sole shareholder. So what happened? We paid cash for what? For dividends. Remember, dividends is a return of assets back to its owners. So we paid $900, which is the asset, back to the owner, who is Worthy. What type of account is dividends? Remember, dividends are part of retained earnings, and dividends reduce retained earnings, so we're going to put the heading title as minus dividends to help you keep in mind that dividends reduce retained earnings and reduce equity in return as well. So two accounts affected by the transaction, cash and dividends. What happened to cash? Did it increase or decrease? Well, we paid dividends, so cash decreased by $900. What about dividends? Did it increase or decrease? We had not paid any dividends, so this $900 dividend payment increased dividends by $900, and that kept our accounting equation balanced because even though dividends increase, overall effect is we subtract it, we take it out of equity to come up with our accounting equation. So that's the last transaction that we were going to go through. So you can see we started with nothing, 0, 0, 0, and as each transaction progressed, the accounting equation was always in balance. So at any given point in time, the accounting equation is always in balance. Another thing that I wanted to tell you is that this is the beginning of our course, so we're going to put this down on this little spreadsheet or table to help you analyze the accounts. By about a week from now, I expect you to know all the accounts and do this transaction analysis in your head. So when we reach debits and credits, we're not going to put this down on paper. We're going to analyze it in our head and then directly apply the debit credit rules to record it in our books of accounts.